Everyone, and welcome to today's webinar. My name is Yaniv, and I thank you for joining me today. As you can tell from the title, my objective today is to make you look at your losses in a different way. And I hope that this will help you take a step towards becoming a consistently successful trader. By the way, I encourage you to take notes during this webinar, and I will leave time at the end for your questions. So, a few words about myself. My name is Yaniv Elbaz, and I'm actually VP Global Operations at Investing.com. I'm actually here at the office right now. I guess at least some of you have heard of Investing.com, a small company. Trading mentality coach and an avid technical analyst. I love analyzing charts or just staring at them. And a day trader. Day trading mostly futures, but also Forex and stocks. I've been trading for the last 12 years. And personally, it took me a long time to become consistently profitable. And I wish I had someone when I started trading to teach me what I know today, or to have, for example, this 3-day sessions with all these great presenters, really awesome presenters and awesome webinars. And for me personally, it would have saved a lot of time and a lot of money. I guess you know what I'm talking about. Today's webinar consists of 6 short sections focusing on one of the most common cognitive biases that traders have and how it affects you. I will give you a few suggestions on how to approach it and what you can do to overcome many of the other obstacles that stand in your way to becoming consistently profitable. The objectives of today's webinar are to increase your awareness to the behavior patterns that adversely affect your trading results, and of course to suggest a few simple yet effective solutions. By the way, as you can see here, section number 6 is a bonus. Although this webinar is not about trading strategies, I've decided for those of you who stay until the end to share a great trading strategy that is also helpful for the bias, the cognitive bias that I'm talking about here today. So stay until the end. I think you'll enjoy this trading strategy as well. Today's webinar, by the way, for today's webinar, I've been invited by the 5%ers to give to you this content. And I'm very happy to share it with their traders and with everyone else here. So many thanks to Gil and the 5%ers for giving me the stage today. The 5%ers is a funded trading and growth program, if you've never heard of it, and it provides unique career enhancers for worldwide Forex traders. So thanks again, and let's start, shall we? So during my work at Investing.com, I've met ex-traders and active traders and started trading stocks and futures as well. In the last few years, I've gone back to the basics of trading. I've started using cleaner charts, I've reduced leverage, and started logging more frequently my trades in a trading journal. And of course, putting much more emphasis on the mental side of trading. With time, I've realized how simple things can be when you keep things simple. Excuse me. These days, I'm focused on enjoying the process of trading and letting the results follow. Since I'm a senior manager here at Investing.com, I don't need to trade for a living, which of course takes away all the pressure from trading. That being said, I'm still, trading because I enjoy it, and I have a trading coach to constantly improve my skills. During my work here, at the company, I've been exposed to the ups and downs of lots of traders through the support tickets and the forums on our website, and really traders around the globe, around the world, and I see their comments, I see their difficulties, and recently I've decided to start helping traders with the biggest challenge, at least I think it's the biggest challenge that most of us face, which is trading mentality. Personally, I've come to the realization that the answer to my questions and problems as a trader, you know, the holy grail that we're looking for is actually lies within. And I remember as a child at my grandparents' house, there was like a small picture that said, it said, a man goes to search his world and returns home to find it. Meaning that, you know, people always look for happiness or for the answers to their questions, usually going outside to the world to search for the answers, and basically find them within themselves or back at home. So the same thing happens to traders all the time. They look for the next holy grail that will be the answer to their trading problems and will magically make them successful or rich. And the truth is that the only thing close to holy grail lies within you, and certainly not outside. I mean, you can try tons of trading techniques and strategies and indicators and algorithms and whatever, but eventually, if you don't have the mentality to trade properly, then the basis or the fundamentals will be missing for your success. And what I want to cover today is just one example for a problem that fails so many traders on their way to success, but has to be addressed from within, as I said, and from the trader's mind and mentality. I will talk about where this problem comes from, but also how you, as a trader who really wants to make a change, can resolve it. The problem I'm talking about is one of the hardest things traders face on a daily basis, and that is taking or accepting a loss. In this presentation, we will cover, or we will see why traders avoid taking a loss, what happens as a consequence, and of course, the most importantly, how to overcome this destructive tendency. And which is, for me, this is really the main thing I want you to take out of this webinar. By the way, the trading strategy that I will share at the end can, like I said, can help you cope more easily with this problem of taking a loss. And that's why I'm bringing it, but it's just an example. And of course, trading mentality is not about a specific trading strategy, and I don't cover specific trading strategies. The mentality is for everything. It doesn't matter if it's day trading or swing trading or investing, if it's the charts or fundamental. Again, it's the fundamentals. The mentality is for everything in trading. It's the basis. So, are you biased? In this section, we will review one of the most common biases traders have. And I will share with you a couple of fascinating and very recent examples to illustrate the extent of this problem. Simply put, a cognitive bias is a systematic error in thinking, part of our brain's hardwiring, that causes us to act repeatedly in an irrational way. We usually are unaware of these subconscious biases, but often we're all making the same irrational mistakes because of them. And if you, as a trader, made the same errors or the same mistakes over and over again and kept asking yourself, why am I doing this? Why is it happening to me? It's probably because of these cognitive biases that you're not even aware of. Confirmation bias, for example, is perhaps the mother of all biases. You know it, this tendency to bury our heads in the sand and selectively interpret information that confirms our prior beliefs. So we see or we put our attention only to the things that we already believe in and disregard all the rest. And many biases appear mostly when you need to make a decision under conditions of uncertainty. And of course, in the case of traders and trading, each trade puts you in such a condition of uncertainty, and day traders, most of everyone else, have to deal with time pressure and fast decision making as well. So when cognitive bias causes problems for everyone, every human being, traders have to be aware of them even more because of the pressure and because of fast decision making, because of the uncertainty. And these biases can wreak havoc in your trading accounts. Probably for some of you, they already have. I can tell you personally that I've decimated several trading accounts, unfortunately. Now, traders that wish to become consistently profitable should not only be aware of these biases, but also take active steps in order to overcome them. The problem is that most traders are not even aware of these cognitive biases, which explains why most traders never become successful. And we know the statistics, you all know them. Most traders fail again and again. Most traders don't succeed. Most traders, step out of the game and never come back. And many others try again and again and again, but can't find the way to becoming consistently profitable or successful. And I think the main problem is that you're just not aware of the root cause of your problems and the biases that make you think and behave the way you do and eventually lose money. The bias I want to cover today is called loss aversion, and I'm sure many of you have heard about it. And it's not risk aversion, it's loss aversion. It's a little bit different. It's even more complicated than risk aversion. And aversion, by the way, for those who don't know the word, is a strong dislike or disinclination. So we're talking about a strong dislike of losses, or like I said at the beginning, avoiding losses. Loss aversion is one of dozens of cognitive biases that all human beings suffer from. Like I said, all human beings, but traders specifically experience it much more because it affects the trading results immediately. And loss aversion refers to people's tendency to prefer avoiding losses to acquiring equivalent gains, meaning you prefer not to lose $5 than to gain or to find $5. So your loss of $5 it feels much worse than gaining $5. So think of it this way. On a scale of 1 to 10, how good would you feel about gaining $500? Okay, 1 being not feeling good at all, and 10 being feeling great, ultimate joy. So how good would you feel about gaining $500? And on the other hand, how bad would you feel about losing $500? So probably, okay, you have the answers and you can already start feeling, or the answers come up in your head. Okay, when I win or find $500, I feel somewhere between, I don't know, maybe 5, maybe 6, maybe 10. When you lose $500, how bad or how strong is the feeling? Okay, 1 being not strong at all, I don't care about losing $500, and 10, I care a lot about losing $500. It makes me very upset, etc. More than that, how long will the feeling last in each case? Okay, how long will you think about winning or gaining $500 or finding $500 on the street? How long will you think about losing $500 or losing them on the street or in a trade? Okay, and probably, okay, I think most of you have answered that the bad feeling about losing $500 would be stronger or heavier than the good feeling about gaining $500. The bad feeling would also last much longer. Okay, imagine after a bad trade, after losing a lot of money, or after, I don't know, losing something, okay, losing an object or not finding something, you keep thinking about it all the time. Why did I lose it? Or why did it happen, etc. When you find something or when you gain something, when you win something, okay, you're happy with it for a few minutes and then you forget about it. So this is exactly what loss aversion is about. It's about the strength of the feeling, of the bad feeling versus the good feeling. And this graph depicts the perceived value or gain or loss on the y-axis. So you can see the y-axis saying, okay, how good you feel or when you make 5 cents, or when you win, or when you find 5 cents. Okay, so let's say around 15. But how bad do you feel when you lose the same amount, 5 cents? You feel much worse. Okay, the feeling, the value, the perceived value, in this case, negative value, is much stronger. And this is the basics of loss aversion. This is this is what causes traders to also take profits or close profitable trades fast, but keep the losses or the losing trades run, because it's really hard for us to take losses. It feels much more painful. Usually they say that the bad feeling is 2.5 times stronger than the good feeling. Okay, and that's the basic explanation for loss aversion and for why it's so hard for us to take losses. Now, if there's one thing or something, the one thing I want you to take from today's webinar is to really, truly, deeply, fully, willingly, and even happily accept your losses when things aren't going as planned. And I'll explain later why even happily. But okay, I'll explain later why you should take your losses happily. Here, I will show you now on this section a few problems and examples for how things go wrong when you do not accept your losses. These are not far-fetched theoretical problems, and I've personally experienced them in the past to various degrees of severity, sometimes even like very severely. Right after I show you these problems, I will present a few simple yet very practical and helpful solutions that will help you handle these problems. So the first problem that is caused by loss aversion, by you not taking your losses, is that you're missing out on other opportunities. When you let your losses run, you keep tracking your losing trades and concentrating on every move. And when the market moves against you, you feel the pain and frustration. And when the market moves in your favor, you feel relieved, hoping that the market will bail you out at break even. Now, concentrating on your losing trades makes you miss out on all the other great opportunities out there, either on the same instrument or the same chart or other charts. So while you're staring at the charts, moving between hope and despair, tick in and tick out, lots of other opportunities are taking place in the market and you're just missing out on them. And that's why I said you should happily take your losses, because once you take your loss, it makes you available in your mind to seeing new opportunities and taking new opportunities, the opportunities that will probably cover for your recent loss, the small loss that you've just taken. Let's look at the following example. You put a sell stop, right? After the price forms a bottom, and you say, maybe you're a breakout trader, and you say, okay, I'll go in once the market goes down and breaks previous low. And the market does break down and consolidates just below your entry point. And you're not setting your stop loss. I mean, you don't, the trend is strong. You know what you're doing. You know where the market is going. And, if something happens, you can always close it later at break even. And so far, so good. But then the market suddenly moves up. And you say, okay, it's natural. The market goes up and down. It'll come down and let's see. But then it keeps moving a little bit up and you start being uncertain. But again, you don't want to take the loss. You're avoiding any losses, and you're now focusing on the downticks, on the red candles that will bail you out at break even, or maybe even a small profit if you're lucky. And while you're hoping to be bailed out, to get out by the market, and hoping that the market will let you get out at break even, you're actually not noticing that the market has reached a potential reversal area, that the resistance point here is actually turning maybe to a support area right where you're staring at the market right now, hoping for it to come down. And you're completely oblivious because all you're concentrating is on your hopes and your fears, what will happen, and you're just not aware of, you're blind spotted and you're not aware of what's happening in the market. And sure enough, the market turns around and you're just, counting your losses, asking yourself why you didn't go out, why you didn't take the loss, or why you didn't put a stop loss. And the story of how you're, beating yourself up for not covering the losses and not basically taking your losses and moving to the next trade. So this is just an example of one problem, missing out on other opportunities when you're not taking a loss. The next one is failing to keep a track record. So you're missing out on methodically testing your trading strategy and seeing if it really works. And if you don't work according to an organized trading plan with a defined exit strategy and risk management, you can't really look back and say what worked for you and what didn't. This is just an example from my trading log, and I log in even my emotions and the signals and where I was sitting at home or at the office during market hours or not, and etc. So I'm trying to log in everything in my trading journal. And this way, when I look back, I can say what worked for me and what didn't. And if you can't learn from your losses and errors, as well as from your wins and achievements, you will not make progress and you will never become professional. The third problem is that you're reinforcing bad thought patterns and bad behavior patterns, especially when the market eventually bails you out from your losses, because then it leads to more of the same behavior that sets you farther and farther away from becoming a professional trader that can consistently grow and achieve great results. You're just not going the right direction, and especially if the market bails you out, you just get a bonus for bad behavior, and this is the worst thing. So if you want to become a pro, if you want to become a professional trader, the first step is to become aware of your biases and thought patterns and how they affect you. And now I'd like to give you two very recent examples, not from the Forex market, but from the stocks and commodities markets, of how bad things can go when you try to avoid losses rather than taking them and moving on to the next trade. Really, just take your losses and move on to the next trade. The first example is, and I'll answer questions later, by the way, for example, trading journal and other questions. The first example I would like to give is Tesla. And the hedge funds and traders that lost billions of dollars shorting Tesla just in the last few months. Notice that the market turned bullish for Tesla at two strong levels, where the short sellers should have noticed that the market is not going their way, is probably turning around, and probably they should have closed their short positions. Take a look at the chart and see if you can recognize these two straight levels, the support and resistance levels. I'll give you a few seconds and tell me if you can see the levels I'm referring to. So yeah, that's right. The first level is right here. Okay, see how the support level turned into resistance, and then with a strong blue or bullish candle broke up, and and the second level, by the way, and look at the volumes. This is something that not all Forex traders have in their platforms for Forex, but obviously for stocks and futures, we also have volume to help us see the strength of the traders. And of course, like you said, the second level is the level of almost 400. And again, a big candle, higher volume. And when the losses of the short sellers started getting too big to hold on to, they closed their short sells, their short trades. And what happens when massive short trades are being closed at once? Of course, they're fueling the buying momentum. And this is exactly what happened with Tesla. It shot up from around $400 to almost $1,000 in just a few weeks. And, it was written about everywhere in the newspaper about the agony of the Tesla bears that, lost in 5 weeks, $8.4 billion. So of course, this is also hedge funds and also, lots of professional traders. But again, this rule of taking your losses when things aren't going your way and just moving on to the next trade applies for everyone. It doesn't matter if you're a retail trader with $5,000 in your account or a hedge fund with billions of dollars. And yeah, Alex here is saying, never go in trades without stop loss, especially in Forex, and I agree. Not only in Forex, but yeah, especially in Forex. Don't trust on your, intuition or on your, discipline to take the loss. Just set a stop loss at the get-go. All right, next example, the second example, and it's an even more recent example. I'm sure all of you have heard about what happened in the oil market recently. Crude oil buyers, and I have personally friends, even here from investing.com, because there are lots of traders here, or ex-traders that said, yeah, oil is so cheap, I'm going to buy USO, the oil ETF, or buy futures, whatever, because it's cheap, it can't go much lower. And then they thought, okay, it's so cheap, I will hold to it, go long. And then, the market hit this support level. And one day, just a few days ago, actually, not very long ago, maybe a couple of weeks ago, or maybe a little bit more than that, maybe a month ago, it broke this level of around 20. A small daily candle. Now ask yourselves, really, as traders, let's say it's a euro dollar chart with a, I don't know, a 15-minute euro dollar chart or whatever, and it breaks the level, the support level. Do you take the loss? Do you put a stop loss? Now, obviously, no one expected or imagined what would happen next. But I remind you, crude oil is traded in contracts, and the expiry of the contract was about to, the contract was about to expire, and the buyers found themselves selling oil at any price just to get rid of the commodity before expiration, or else they would have to take physical barrels or pay for the storage. And look, the oil hit almost minus $40. Could you imagine a commodity hitting minus? This was totally crazy. The market went berserk, and this is unheard of, but you see history was unfolding in front of our eyes. Take your losses. You never know what might happen. And, with the Forex market, I always remember what happened with the euro versus the Swiss when the central bank of Switzerland dropped the floor from 120. That was also one heck of an event. So now you understand, I hope, the implications of loss aversion. And you've seen how bad things can go when you hold on to your losing trades. And I would like to suggest a few simple solutions to overcome this destructive pattern. First of all, feel comfortable. Define the risk you're comfortable with, the loss you're willing to take ahead of the trade, before entering the trade. And then, before you enter the trade, define exactly how much you're willing to risk, and imagine, what would it feel like at the end of the trade if you lost this amount that you defined? If you feel panicked or uncomfortable about it, reduce the position size or skip the trade altogether. When you imagine the market getting close to your stop loss, just close your eyes before you enter the trade, set your stop, and then imagine it getting close to your stop loss. You should feel completely indifferent and relaxed. And that's what I do today. I set my position size. It's not a big one. I'm not looking to, score thousands of and tens of thousands of dollars in one trade. But I set the stop loss, and I don't care. I'm completely indifferent to whether the market will hit my stop loss or eventually reach the take profit. Mark Douglas, by the way, called it trading from a carefree state of mind. Alex is saying correctly, when you're comfortable when you're not checking the trade every 10 minutes or every 10 seconds. Absolutely. When you can let go of the charts and let the trade run, that means you're comfortable. Thank you, Alex. After that, set your stop loss and position size accordingly. And remember to set the risk so that you will feel comfortable not only with one losing trade, but also with a losing streak. So you have a series of trades. You're not trading just once. So every time, or decide on a position size that will take you through the next few trades, or the next, series of trades, 20, 30, 50 trades, and see that you're willing to risk even if you lost 5 or 10 trades in a row for some reason. Well, 10 trades maybe is too much, or exaggerated, because it's hard for any trader to absorb emotionally 10 losing trades. But it can happen that you lose 3, 4 trades in a row, even if you have an edge, a good edge. Tony Saliba, a trader, a hedge fund manager, said, "I always define my risk, and I don't have to worry about it." Very simple. The second suggestion is to think of trading as your business, in which losses are simply expenses. And if you want to trade like a professional trader, then you must realize that you also have business expenses in the form of commissions, the bid-ask gap, or I forgot the word now, or the losses. So you must realize that you also have business expenses, just like any other business. Luckily, for you at least, unlike regular business, for you as a trader, these losses are only potential expenses that you might absorb. Why potential? Because only some of the trades will end up with a loss, not all of them. So remember that when you open a trade, in order to see if your opinion about where the market is going is correct, and checking your opinion might have a cost, okay? This is the loss, this is the cost, and this is a loss that you're comfortable with. So that's all there is to it. It's a business expense, and that's it. That's all there is to it. And the third suggestion is to maintain a trading journal. Because not only not only of your position size and where you entered, where you exited, and how much you made or lost, but also of your environment, preparations, thoughts, emotions, conclusions, all of that. This is the best way for you to learn over time what you need to keep or maintain, and what you need to change in your trading methodology and routines. So without analyzing your trades and looking at the statistics and understanding what works for you and what doesn't work for you, you can't become a consistently profitable trader. You're just a gambler. So you want to become professional, start journaling, using a trading journal. And by the way, these screenshots are from Edgewonk. It's a nice trading journal that I use. If you keep a trading journal, by the way, it will also make it easier for you to take losses and help you with loss aversion. Why? Because you can see how often you lose, and that despite your losses, you're making progress. So there's no need to get excited about each and every loss. And here in this example, you can see that I've put as an example a win rate of around 55%. That means that 11 out of 20 trades are winners and 9 out of 20 trades are losers. Imagine, out of every 20 trades, you lose 9 trades or 9 positions. And still, and with a very moderate risk-reward ratio of around 1.7. I'm not even saying take profit of double the stop loss or 3 times or whatever. 1.7, even 1.5 will work amazingly well for you. And then you see that over time, even if there are occasional drawdowns, they are not, the big or huge drawdowns that decimate your account. And over time, you can see that even if you have a losing streak, it's okay. You're still making progress. So trading journal helps a lot with loss aversion as well. And Peter Lynch said, in this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. And I showed you even with fewer, even with less than 6 times out of 10, fewer winning trades, you can still be consistently profitable. So by now you know and understand one of the most common cognitive biases, loss aversion, how it can adversely affect you and your judgment and your trading results. And I've showed you some suggestions that can help you overcome the problem. As I said at the beginning of this webinar, it took me a long time to seriously address my thought patterns and biases and learn how to really think like a pro. And until then, I have lost a lot of time and money, precious time, really, and countless hours of sleep. Now, you're probably trading in order to provide for your family, quit your job, have a more comfortable life, or make money from anywhere around the world. Unfortunately, for most traders, there is a yawning gap between aspirations and reality. And many traders find themselves in a vicious cycle of hope and despair, experiencing inconsistent results and mood swings. And statistically, most traders fail, but that's because most traders look for the wrong solutions to their problems, concentrating on the 10% of trading strategies. And at best, touch on the additional 20% of risk management. But only top traders, like professional, just like top athletes, put most of their attention on the mentality aspect of trading. And just like in any high performance vocation, top traders have coaches to help them get to their peak performance and maximize their potential and their abilities. So if you're struggling to become consistently profitable, but you want to achieve your goals, you need to do whatever it takes to make progress. And then nothing will get in your way. If you're determined to take your trading skills and trading results to the next level, and not by looking for magic solutions and holy grails, then I'm here to help you make it happen. I have crafted the mental trading skill set workshop. And it's exactly for this purpose, because I know that the only way to achieve consistency in trading is to do the necessary work of facing your internal obstacles and working according to a well-defined framework. The mental trading skill set workshop is all about giving you the tools to unveil the underlying causes for your trading errors, dismantle them, and rebuild your trading framework to support your goals as a trader. This is key to success. And note that this workshop is relevant for any trading methodology and any time frame you choose to use. During the workshop, you will learn to recognize your limiting beliefs and negative thought or behavior patterns, become aware of them before they mess up with your trading. Then you will ingrain and reinforce new positive patterns that will help you make the desired progress and see very quickly how things start changing for you. Then the positive results will follow. As part of this boutique workshop, and it is a boutique workshop, we are going to meet together in 4 group sessions of 90 minutes with valuable, mind-blowing materials that will open up your eyes and change the way you look at the market, and especially the way you look at yourself as a trader. And in addition, we will have 4 one-on-one private coaching sessions of 45 minutes in which you and I will look much more closely and deeply into your goals and your challenges, your achievements, your thought process, your behavior patterns, and trading routines, and much more. Now, I give you my full attention during the entire coaching period, which is almost 2 months, because the private coaching sessions go beyond the group sessions. And I meet with you one-on-one. So I check your assignments, I answer your emails. So this workshop, like I said, is a boutique workshop, and it's limited to 10 traders per workshop. And I remind you, I'm a VP at investing.com, so I do it only at my limited free hours after work or before work. And that's why I'm taking only 10 traders at a time to work with them very, very closely. This workshop includes, in addition, home exercises and questionnaires that will really will help you get much more familiar with yourself and with your thought patterns. And by the end of the workshop, you will have created what I call your tempo book. It's the trader's extensive mastery plan and objectives. This is a personalized trading framework that covers all the necessary aspects to step up your trading skills and take a huge step towards becoming a consistently successful trader. My promise to you is that once you join this workshop, I will give you my full attention and all my knowledge to help you make the progress every week. We will be working throughout this entire process together to make sure you're making the most out of this workshop. And I guarantee one thing, I assure you that you are not going to do this alone. And I'm with you along this entire process. And it's not an easy process because it requires that you look deep into yourself, that you be sincere with yourself, that you do the work. And changing is the hardest thing to do. Changing thought patterns, changing habits, but how you change is how you succeed. And ask yourself, am I willing to do whatever it takes to become a consistently profitable and successful trader? Or am I satisfied with where I'm at right now? Now, if it's important to you, you will find a way. If not, you'll find an excuse. So at the end of the day, if you want things in your life to change, you have to change things in your life and in your trading. And the only way you will make a change is if you find a way. So how can you step up your trading game? By taking action now. Not in a few months, or not when you finish watching something on Netflix, or not when, find the time or the money or whatever. Take action now and sign up on Dojis.com/workshop. I've started working on this Dojis website. I told you I love charts, and I love doji candles specifically, so I've decided to set up this small website called Dojis.com. I've built it myself in the last couple of months or so. As a previous product manager, I enjoy also building products and websites. Sign up on Dojis.com/workshop and use coupon code TEMPO20. When you go to the cart, sign in or write TEMPO20 to get a 30% discount. And I know there are many 5%ers traders here. So for the active traders of the 5%ers, there are special deals as well. So more details can be found on the 5%ers. Now, as I've promised you, a small bonus, a simple but effective trading strategy that you may find useful, and I call it the hidden zones strategy. I'm showing it as an example of a trading strategy that can help you address your loss aversion, since it is simple, it has great success rates and very clear entry and exit strategies. So you can keep a track record of your trades and see very quickly if it works for you. Note that the mental trading skill set workshop is relevant for any trading methodology and any time frame you choose to use. This is just an example. This trading strategy is based on supply, demand, or support and resistance zones, along with hidden divergences. I'll explain in a minute what a hidden divergence is. preferably around the overbought or oversold zones. And I use here the stochastic oscillator set to 853. You can use CCI, you can use RSI, but stochastic is somewhat is better for this strategy. You obviously set your stop loss beyond the zone, above or below it, and the take profit, obviously before you enter the trade, you make sure that the next zone, the next supplier demand or the next support or resistance give you enough room for the trade to run so that you have at least 1.5 risk units. So if the stop loss is, I don't know, 20 pips, then you have enough space to run for at least 30 pips. Hidden divergence occurs when the oscillator makes a higher high or a lower low while the price doesn't. It's the other way of a regular divergence. In a regular divergence, the price makes a higher high and the oscillator makes a lower high. Here, the oscillator is actually making a higher high when the price doesn't. And this often occurs during consolidation or corrections within an existing trend just before it resumes. So it's a great strategy because it gives you trading signals for continuation. And I always love to trade with the trend. So here are a few examples. Gold futures, you can see here a trading zone forming, or a supply zone forming, and you can see that once the price returned to the same supply zone, it formed higher highs in the oscillator relatively to the previous high in the oscillator, even though the price didn't make a higher high. And you can actually even see here a double divergence, because the first divergence is even a regular divergence, so it's even a stronger signal. You have both a hidden divergence and a regular divergence. You set your stop loss somewhere above the zone, so there is not much room for hesitation or for doubt. You just set your stop loss and you let the market validate your trade. And you set your 1.5 hours or your risk units, your take profit at the next support or demand zone. And here you have plenty of room, at least to this area and even to lower areas. So it's a perfect setup. And you can see here another setup of consolidation, returning back to resistance, on the right side of the chart, and a very strong overbought indication from the oscillator. Again, hidden divergence with a resistance zone, giving you the perfect setup to enter short with a very minimal stop loss. Another example. Dollar yen, 15 minutes. We see here resistance. We see a strong breakout of the resistance area and returning to the resistance, which turned to support. Now testing support, consolidating above the support area, and you can see how the oscillator almost touching the oversold area, the oversold zone, and of course forming a lower low in the oscillator. You see here 2 dodgy candles forming, showing hesitation, so showing consolidation, and you set your stop loss just below this support area, and you have the first target right around the resistance, but you can see the trade going even much higher. So again, these signals are great, and personally, I don't use them much, but I love them because I see them a lot, and when I do use them, they work out greatly. Really great. So another example, S&P futures on a 1-hour chart. You can see here again, resistance turning to support, the price moving up from the blue line. You see the blue line on May 4th moving up, going back down to May 6th, the red line, again to the same support level, but this time the oscillator is in the oversold zone and much lower than previous lows. and giving one confirmation candle. You can enter at the end of this candle, set your stop loss right below. Okay, great risk reward ratio because the resistance levels or the supply zones are very far up high. So you have plenty of room for 2, even 3 Rs, and the trade is working out perfectly. And the last example before I finish this webinar, euro dollar. This is maybe for swingers on a 4-hour chart. Again, a supply zone forming, creating even on the RSI and also, of course, on the stochastic. Yes, the 853 in this case, stochastic 853, RSI 14. It's forming a overbought signal, and also not only a hidden divergence, but also a regular divergence. So again, you can see that when you hit, for example, a supply zone with both a hidden divergence and a regular divergence, it's super strong, and you have super moves coming out of this. And you can see, by the way, just at the end of the chart, this chart is, I think, from just a few weeks ago. You can see how, or maybe a couple of weeks ago, you can see how it formed another hidden divergence. Okay, the oscillator reached oversold, overbought again. And for every time frame. I want to thank you for being with me on this webinar, and I would like to thank again the 5%ers for giving me the stage today, to Gil and all the guys there. Not only do they fund their traders, they also help them in their trading journey and even subsidize the active traders. They give them a subsidy for the mental trading skill set workshop. They do everything for their traders, their active traders, to succeed in trading. Thank you very much, Anka, David, and TimingResearch for this opportunity. And I really enjoyed it, and I enjoyed all the other webinars as well.